Randy Elvis Frisky and his Las Vegas Show Band 40th Anniversary Aloha Tour this January in Chilliwack, Surrey, Sydney, Campbell River, Nanaimo, and Courtney. On sale now. Details at randyelvisfrisky.com.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Ross Clark with CIBC Wood Gundy is our guest, and we are glad to have him with us here on This Week in Money. President Obama meeting with congressional leaders today, Ross. U.S. edging toward the fiscal cliff. We've been talking about this for a while. That could tip the country back into recession, kill any recovery next year. Markets reacting as we would expect they will. Wall Street headed for its longest losing streak in 3 months. What's going on here, Ross?
But also one of its best winning streaks in quite a while. You know, if we count back to March of 2009. It's, everything all in context. There was, I think, little doubt in people's minds that from a political perspective that the fiscal cliff negotiations would have to go down to the wire, just like we did a year and a half ago when it came to the debt ceiling, of which there was no conclusion. That was just pushed forward until we're coming up on that in another month. But the markets, if we take a look at it overall, since the election, the market took a bit of a break, but recovered decently into about a week and a half ago, and now has had this downside move this week. Clearly there are concerns out there, but it's day by day, minute by minute in terms of what the news bite is as to how the negotiations are going along. And even at this point, I mean, you could get the congressional leaders agreeing with the president, but whether they can get the votes is another thing altogether.
And a lot of folks wondering whether this is a cliff or a hill or a pothole. What the heck is it?
Well, I've been of the mindset that it's a hill because I think fiscal cliff is still 6 months to another year down the road before things really reach an extreme. They will inevitably find a way of pushing through something here in the way of legislation to get through the next period, whatever it is, 6 months to a year. I don't think they can do much further than that because the right wing is just not going to come around enough to do what is truly necessary.
And all of that continuing uncertainty, of course, that's got to be roiling markets back and forth for the foreseeable future.
Well, it is, but if we think about fiscal cliff, it's been out there as a concern for quite a while, and markets have had a reasonably good upside bias since the summer. There's been some shakeouts, but if we look at, as I like to look at, some of the seasonal patterns, and in particular when it comes to the equity markets, you look at the presidential election cycle in the States, and the norm is that you have a high usually around the end of the first quarter of the year. We had that, a low out in June, which we had, a rally to September, which we had. The only thing that's deviated a little bit is that following the election, market continued down into November, a little bit longer than usual, before it had a bit of a lift. And if I look out into the first quarter of the year and what we might be looking at, the normal action in the first year of a president's term, or in this case, the re-election, you tend to find choppiness in the first quarter, upside bias in the second, and then things can get a little rough for the second half of the year. So my view on this one, I think that we can look at sort of markets around the world as probably going through a process like we saw in 2007 to early 2008, where you've got a bit of a rolling top. Some markets running longer than others. If you recall back to 2008, the resource side of the markets really kept Canada doing very, very well, independent of some of the others. And I think if we look at the work that I've got at this point would suggest that the weakest of the markets maybe start to top out in January, secondary highs in March, and by May I would think the best of things is behind us.
Ross Clark from CIBC Wood Gundy, our guest here on This Week in Money. We had a pretty good year despite all this fiscal cliff uncertainty in the North American markets. How did European markets and Asian markets do this year?
Europe had just, for all that they have all the bad news, it was one of the better performing sectors. I mean, you look over there, DAX is up 30%. Now, I like to look at things on a using a measurement stick that is equal across all borders. So rather than look at the returns of an individual index, where one might be measured, say if you're in Europe, you're measuring in euros. If you're in Japan, you're measuring in yen. What I like to do is take a look at everything based in U.S. dollars. So you've got a constant there. So you're up 31% or so on the DAX. The Greek market is done extremely well as well here. You're looking at 26% on the year for Greece.
Wow!
And from the lows when things were really, really bad out in May, June, all the uproar on the streets, and we ended up with Greece up over 100% from the lows that we saw in May, June to where we are at this point in the year. Versus, the North American markets where you've got, the Dow up 6%, S&P up 12%, Toronto up, in 3% for Canadian dollars, but about 5% when you price it in U.S. dollars. So the key to any of the markets is looking for opportunity. You look for excesses that markets can turn from. And the point at which things seem the most dire inevitably becomes the point where it feels like the greatest risk, but it's actually one of the least, as long as you can use some stop losses, use some money management techniques. That's where your returns come from.
Do your due diligence and be ready to jump at the earliest opportunity, right?
Oh, yeah. And we talked about Shanghai here about 2 or 3 weeks ago, and the turn that we were starting to see there. And just, looking at measurements off the low, it looked reasonable to look for maybe a 40 to 50% move off the bottom. And some of the funds, like the China funds, are already up 15% or so, off 20% off their lows. So whereas markets that are already up and looking strong, it's hard for them to tack on those large percentage gains. It's far easier to find the ones coming off of lows or just coming out of consolidation patterns where you can get your big performance.
We have not heard much from Japan this year except economic bad news. What's the Japanese market been doing this year?
Well, the Japanese, they've had a change here in terms of government, which is good, and now you've got the Bank of Japan as well as the government on a policy of working towards a lower yen. They're trying to do all they can for the export market. They're trying to stimulate the economy, and it is working. You're starting to see significant upside action in the Nikkei, and it's had, I would say, just an extremely good move since the middle of November, and in particular up until about a week ago. Now, in the last week, the Nikkei has made some further progress. However, for international investors looking at it, priced in their own currencies, we're starting to see the upside action on the Nikkei merely reflecting the decline in the yen. Okay. So it looks as though this move might be running out of steam a little bit and due for a correction at this point. Some of the Japanese stocks that we've been following, there's a couple of them here that are up over 30% just in the last month and a half. And they're once again, a market that everyone has learned to see as a low-performing market, but it does produce excellent results. I should say that for all that most of us will price the Nikkei just in terms of yen and look at the index. If you take a look at it priced in U.S. dollars, and you come from the all-time high back in 1989 in this 22-year bear market that it's been in, there's just a wonderful resistance line that sits there on the chart. And I think we're up against it for maybe the fourth or fifth time right now.
Are we going to bounce off that resistance and go higher?
I would suspect, just because we're looking a little overbought here, we probably settle back a bit.
Okay.
But if it pops through here, you could be looking just at a major shift. And after a 22-year secular bear market with a lot of good 25 to 40% rallies within it, but a secular bear market of 20-odd years, this one may be very ripe to have some good, more consistent upside action than short-lived sort of 4 to 6 month runs.
So it doesn't feel like we're skiing uphill anymore.
No, it doesn't. It's starting to feel like this is a significant bottom that's being put in place.
Ross Clark from CIBC Wood Gundy, our guest here on This Week in Money. We're talking about the markets, the currencies, and the precious metals today, a kind of a year-end wrap of things going on. And you talked about the yen earlier. This is a surprise to me. The dollar climbing to its highest level against the yen since 2010. The dollar index slipping a little bit today, but it's had a pretty good year.
Yep, dollar index topped out in the spring and had a good correction down into the summer and has been holding its own since then. We're pretty much boxed in here. Bottom end around 79 on the index, the top end at 81.5. And as you know, we've talked over the last year or two about the similarity of what I'll call a large basing pattern for the last couple of years versus the 1996 pattern and versus the 1981. And where we sit right in that one now is such that as long as the dollar can hold around 79, maybe 78.5, but this general area, and then push through 81 on the index, that should be a catalyst to then push it up to the next resistance at 83, and through there, you start to look at the index maybe getting up around 90. So that's from 80 to 90 would be a pretty significant move from a currency perspective. And that's all part of this 16-year cycle that I keep an eye on as far as the dollar is concerned. So threshold levels, I say support. Think of that as that 79 area. First resistance at 81, but starting to move through there, we could be looking at some pretty significant moves.
Ross Clark from CIBC Wood Gundy, our guest here on This Week in Money. Gold had a pretty good year, started the year at 1,600. We came close to 1,800 a couple of times. It's lower a little bit today, but still on track for a 12th straight year of gains, and that's kind of impressive.
Yeah, this is, it's been a disheartening year for bulls and bears, really, because as markets have gone up and tested resistance, they've very, very quickly given up ground. Only to create spike lows and then quickly come back. So unless you were pricing ahead of time and preemptively putting orders in above and below the market to take advantage of it, it's been a year without a lot of significant price action in terms of a net basis. I think that the consolidation we're looking at, compare this to the bull markets of the early 70s, the late 70s, and then the early part of this bull market, 2003 to 2004. This pattern is similar, but taking longer to develop, and I see it most like the 03-04 phase. Right now, we've positioned similar to the summer of 2004. And as long as prices can hold in the 16.25 to 16.40 level, and ideally around 16.40, then that would suggest to me that we have an excellent chance of pushing through 1,800 in the first quarter of the year. As I say, the thresholds are always important in terms of support, so that 16.25 to 16.40 is extremely significant in terms of the short term. If we violate that, and I have to think about it just from a technical perspective, not from a fundamental, because the fundamentals, as I understand them, and you look at debt to GDPs and other ratios, it's very easy to justify gold going up maybe at $200 a year as the nominal movement over the next number of years. But if I look at it from a technical perspective, if we break the 16.25, then naturally the low to mid 1500s come into play. But the most important ones will be down at the 50-month moving average at 1390, and I really wouldn't want to see us go down to there, but if we do violate the low 15s, I think that's what we'd be looking at.
I got to ask the dumb guy question of the week here, Ross. With all the bad news we have been reading and hearing about, why does gold seem stuck in that trading range? Do you think it'd be going parabolic?
Well, I think, also look at the fact of, what it has already done. I mean, this market's sitting at, 1750-ish, up from, it started at $250. This market, and even, from 2008, it was at 700. So percentage-wise, we've already seen some pretty big moves. And there's a lot of good cash demand from what I understand underneath the market. Each one of these breaks sees central governments, it sees business, and it sees individuals out there making physical purchases, putting it away. And a lot of this it doesn't come back to the market. It's put in safekeeping, and that's where it stays. So it's a matter of time. Markets will move in large. They will have large moves and then consolidations. And I think one of the important things to look at gold here is that it had, a bubble top, if we look at it, in August, September of last year. That run to 1900 was really excessive, just like the move in silver to $50 was very excessive. And I think it's done just an excellent job of absorbing the flow that's come back at it without giving up much ground. My gosh, 1900 down to 15.25. That is a very small correction after you've made a move of the magnitude that we've seen over the last 10 or 12 years.
Ross Clark from CIBC Wood Gundy, our guest here on This Week in Money. And from bullion to metal stocks, we are looking at that continuing disconnect here. The big five all had a lousy year, all off between 20 and 30%. Why are we still seeing this disconnect between the stocks and the underlying fundamentals?
Well, we seem to get these big percentage moves when the mining stocks come off their lows. I mean, look at like the XAU off the spring low. And this is where we were looking at an extreme in the relative strength index of gold or mining stocks to gold, also gold relative to the S&P, mining stocks relative to the S&P. All those ratios were at real excesses in the spring. And percentage-wise, the mining stocks had beautiful moves off the low, but it only lasted about 6 to 8 weeks, and now they've worked their way back down. One of the big things that's going on out here is that the reserves that these mining companies have got, they don't have the ore and the grades of ore that they did 4 and 5 years ago.
Okay.
And so you're doing a lot more work to come up with the same amount of ore. And it's harder and harder to find good bodies, good ore bodies going forward right now. So the mining stocks, and in particular the ones that need to raise cash, are having difficulties. So I think one has to look at these markets as much as any market as one that you take advantage of the large swings when you get them. You get a 20 or 30% move in an item, you want to bank some of that money and then wait for the next opportunity to come along.
Now, speaking of opportunities, you have a great idea here to help us make some money in these choppy markets. TTOP, what does that stand for? What does it do?
Yeah, what we've been doing here, as people know from a technical perspective, I like to look for opportunities. I look for extremes. So markets, when they create what I call capitulation lows or exhaustion highs, when your last seller has sold because the news is so bad, or your last buyer has bought because the news is so good, you tend to see markets pull back from those levels. And so one of the things that I've been doing over the years, and we've refined it now to what we call our TTOP, Technical Trading Opportunities Program, for clients. We take a look, and this is all systematic. We run scans every day that look for stocks, ETFs, or indices that have become excessive, in this case, on the downside, on a weekly or monthly basis. And then we wait until daily signals kick in that show us that the market has lost showing signs of stability, losing its downside momentum, and is now showing improving money flow. And the objective, therefore, is to find nice oversold items that have a chance of a decent recovery. Now, they may not go back to make new highs, and this is purely technically oriented as far as the trades are concerned. But what we're looking for are markets that have this type of oversold condition where you will typically get an 11 to 20% recovery rally coming back off those lows. And that usually takes 4 to 8 weeks. That's the time frame on that. And so if we're in markets that are really thrashing quite a bit, and you have very few stocks that are trending well to the upside, this becomes a way to glean some profits out of that type of market action.
For folks who want more info on TTOP, how can they contact you, Rod?
They can call me in Vancouver at 604-661-7759, or send me an email. That they can do at ross.clark@cibc.ca. And if anyone wants any charts that relate to things that we've talked about here today, they can get a hold of me at chartworks@gmail.com.
Ross Clark, thanks. It's been a great year, and thank you for all the insight that you have brought to us this year, and we look forward to more next year.
Always enjoy our sessions and look forward to next year.
This Week in Money is archived online at talkdigitalnetwork.com.
David Smith is a precious metals analyst and frequent contributor to the Morgan Report at silver-investor.com. He joins us from his home in Seattle, Washington. Hey, David, it's good to have you back on This Week in Money.
Great to be back, Phil. I'm really excited about the wrap-up for this year, which we've been through a lot, but I'm looking forward to 2013 and 2014.
Hey, me too. We're going to cover a couple of different areas relating to precious metals. We're going to talk about bullion first, then we're going to talk about the ETFs, and then we're going to talk about what's going on with the miners themselves. All interesting stuff, and we're going to wrap up with a few words of advice for all of us for 2013. Let's start with gold. It is steady today near 1660. Markets focused on that fiscal cliff and the weak U.S. dollar. Gold is up 6% so far. It's on track for a 12th straight year of gains, and that is good news.
It's really amazing, and I think rather than seeing the market as being long in the tooth after rising for 12 consecutive years, and I can't think of another investment that's done that in recent memory, I would say that it's a testament to the underlying power and strength of the gold market, and it really gives the odds really favorable that we're going to see much higher prices over the next few years leading up to a public mania, because it's just been moving inexorably higher, very like the deep currents of a lake that aren't obvious on top, but down deep things are really going on that are profound.
One of the things that makes us scratch our heads, David, everything we see in the global economy, everything we read in the news says gold should just be going through the roof, but it seems stuck in that $1,700 trading range.
It does seem to be that way, and so does silver, and silver certainly should be much higher than it is. But there's a situation with the paper trading where we have paper silver and paper gold, and there's this confidence level that there's actually something backing that in a lot of cases. And that confidence is eroding, as we've been seeing this year especially, questioning whether the central banks and a lot of even some of the funds even have the metal that they think that they have, or they say that they do, because they carry it on the books when it's leased out as though it's actually in the vault. And as that confidence continues to erode and the investment demand continues to ratchet up, I think we're going to see the paper being overwhelmed by the physical. And when the physical just isn't there, then the mining shares are going to start going ballistic at some point.
David Smith, our guest here on This Week in Money. Always nice to pull a couple of quotes from people we respect in the business. Here's Jim Rogers. Gold has been going sideways since September 2011. It wouldn't surprise him, he says, if the correction continues. And Jim says, if gold goes down more, I hope to buy more. If it goes down a lot, I hope to buy a lot more. So he's optimistic.
Right. And, the sideways movements can be as devastating morale-wise to investors as a big drop, because it just kind of corrosive and it eats away at your optimism, and you either hold on to the big picture that things are going to be better, or you give up and get knocked out, and especially if you've committed all your money. So it's important to preserve your emotional capital, because you just can't afford to lose that, and we can come back to that a little bit later, but I think it's a critical thing that investors need to hold on to if they're going to be able to keep their emotions under control and stay on the gold and silver bull.
Here's Peter Schiff saying, stick with gold despite a recent downturn in bullion prices. Schiff, seeing the long-term fundamental picture for the U.S. getting worse, says there's no safe harbor in currencies like the U.S. dollar, and he feels like a lot of us do, that precious metals have intrinsic value. Tell us about that.
Well, they do, and the metals have been around as a helpmate for thousands of years, and of course we always look at them as insurance first and profit second. And the profit for silver was, obviously there's more profit potential when you bought it at 5 than at 30, but the point is it should go much, much higher, and it's also a preservation of wealth and a storage of that. And while we've been mentioning a couple of people that have been writing out there and talking about where we are now, a couple more names that I think people ought to take a look at. Adam Hamilton wrote an interesting essay on the effect of silver prices with the QE3 that's underway now, with the expansion of the Federal Reserve monetizing our debt, and the increase in what's going on with Japan, where they're going to try to bring themselves up from a minus 2% to a positive 2% inflation rate. So all around the world, countries are reflating their currencies with paper backed by nothing, and this is going to have a very profound effect on the metals. Another one that was really fascinating to me, this was in the last week, Eric Sprott had written an article about the amount of silver that is available in relationship to gold for investors, and if I remember correctly, he said it was about 3 to 1. So in other words, for every ounce that is available for purchase for investors of gold, there are about 3 ounces of silver that's actually out there, free silver. And yet the demand that's been going on in terms of the dollars that have been going into it have been closer to 40 to 1. So there's a tremendous amount that just continues. The U.S. Silver Eagles have sold out for the rest of the year, this type of a thing. And if that investor demand continues at pace, not just in the United States, but around the globe, at some point the silver physical ability, to satisfy that demand is going to get overwhelmed, and it's going to lead to what David Morgan has long said. It was just going to take the last ounce of silver available before the paper market collapses. And I think we're moving toward that. It may not happen right away, but it's in the pipeline as long as this demand continues unabated.
So what's the takeaway here? Are we going to see a dramatic increase in silver prices, more dramatic than the possible increase in gold prices here?
I think on a percentage-wise, that's a very high probability that will happen. And once that physical supply is gone, and of course, even if the physical is out there in certain form, the premiums can go higher. So when you get down to the point where it's being overwhelmed by the demand, yes, you can still maybe get that silver for a while, but instead of paying a premium of 75 cents or $1 or $1.25, you might see it at $3 or $4. And there's actually some places where that's going on now. So it isn't like you have to buy it today, but if you don't have a position at all, don't think that you can just wait and then suddenly go out and get it. And even if you can, that you might not pay a very, very high premium for doing so.
What about the China effect here on the price of gold and silver?
China, to all intents and purposes, just keeps buying very large amounts of gold. They soak up all the production that they have on their own. They soak up all the silver production. It was only a few years ago that China was a substantial exporter of silver. Now they've become a net importer, and that really is a pretty amazing thing, and it's going to keep on, I believe. And this idea of these takedowns in the price, people call it conspiracy, but I don't think we need to even use that term. It's just different entities operating in their own self-interest, whether it's large funds that they're trying to profit from short sales, or whether it's governments that understand that gold and silver are barometers of the health of the policies that they're pursuing. And they don't want to see a gold price going up through the roof or a silver price rocketing higher, because that tells people publicly by the expression of that price that all is not well with the policies that they're pursuing. And they haven't had very good luck at keeping things down. If you remember, it was only a few years ago that gold was below $1,000, and people thought, well, it would never get above $1,000. And now look at it. It's knocked close to $1,900 a couple times, a little over. So they're having less and less effect. It's like putting that beach ball down into the water, and the more you try to push it down, the more it's going to pop up and come out of the water at some point, because you just can't hold it down.
Speaking of down in the water, one of the most fascinating stories, David, of 2012, happened in this summertime. They found 48 tons of silver bullion in a World War II shipwreck off the coast of Ireland. Now, were that 48 tons all to be released into the market at the same time, what would that do? Would that change the price of silver at all?
Well, it might, but it's almost like central bank gold sales. It used to happen if the demand is in there to soak it up, and it's like what we've seen lately with gold, where gold has been down down around the 1600 area, it's uncovered a lot of demand from fairly large entities. And there's a lot of anecdotal evidence that there are wealthy individuals that are stepping up to the plate and placing very large orders for both physical silver and physical gold. So I think that would be soaked up pretty quickly. Yeah. But it's even though silver is in a surplus now, and we have new highs of silver production, the demand continues there, and as long as that continues apace, and if we see any kind of rebound in the economies around the world, it's going to be soaked up more for industrial as well too. So I think going forward, we're going to have to expect a lot of volatility with prices up and down, but the trend remains up at this point.
David, one of the things that we always like to look at is quantitative easing and its effect on precious metals. Here's an amazing little nugget from this year. Silver rose 53% during QE1. That was twice as much as gold. 24% during QET, 3 times as much as gold. So obviously all this money printing is good for gold, but it's good for silver by orders of magnitude.
It really is. And, the report that I referred to earlier that Adam Hamilton put out in the public domain a couple of weeks ago discusses that and mentions some of those very statistics that you mentioned. So that money gets put out into circulation to try to stimulate the economy, but the Fed loses control of where it goes. And so, a lot of it goes into speculative vehicles because people understand that it's debasing the value of that very paper money down the line, and so they buy things that they hope will keep value, whether it's the precious metals, mining shares, or real estate, things like that, or even art and things like that. So it expresses itself in unintended ways that aren't always exactly what the Fed would like to see, including the overall stock market.
What are we going to be able to look forward to for 2013 for silver and gold, David? What do you think?
Well, I think we're going to see. A challenge of the all-time highs, perhaps this spring. I think we're going to see a lot of volatility, and whether we'll end up 2013 with a 13th year for a gold rise, I don't know. I mean, nobody can predict that far out. But I think if people can just kind of contain themselves and not go on margin and not get too much of a position where they can't sleep at night and just hang on to what they have and have a little money to buy into severe weakness for the stocks that they feel are best of breed, and maybe pick up a little more physical when they get a chance, I think they're going to be very happy about it as we go through 2013 and into 2014, because the systemic issues that have launched this bull market, and even the supply-demand issues, I mean, we don't need societal chaos to see gold $1,000 or $2,000 or $3,000 higher, and we don't need that to see silver at 50 or 60 or 100 or 150. These things can happen simply because of all the issues that you and I have been talking about here today, and the issues of it's getting harder and harder to get that metal out of the ground and more costly in relationship to the demand, both by industry and by individual investors and hedge funds.
We're talking to David Smith. We're talking about gold, silver, all kinds of precious metals here on This Week in Money. Let's talk about the ETF space. Most folks familiar with ETFs, they're a great way to get involved in ownership, and you've got some liquidity as well. But look at some of these numbers. Here's the big bullion ETFs, the GLD up 6%, the SLV up 9%, and that's encouraging. But look at the mining ETFs. Here's the GDX, the Senior Miner Index. It's down 12% year to date. The GDXJ, down 22%. Again, we're seeing this huge disconnect between bullion and miners.
We really are, and this has continued, and Frank Holmes has spoken about this a number of times, and he's shown that the mining stocks have actually expressed themselves as 2 standard deviations away from what they would have expected to do in relationship to the metal, and so they're underperforming. They're in a position where 97% of the time that would not occur. So at some point that's going to spring back, but it's been a long way for people because it's persisted for several years, and some of them are injuries that the industry has put on itself by issuing too many shares, and there's also the issue of competition for the ETF vehicles that you mentioned and things like that. But at some point, the quality miners are going to turn around and close that gap, getting back up to the relationship that they should hold with the metal itself. And indeed, this usually happens late in the cycle. So we're not seeing something here that really is unprecedented, because as we move into the latter stages of the precious metals bull market, I think you're going to start seeing first a relationship closing that performance to the metal, and then near the end days, so to speak, an outperformance by the mining shares as the public comes into it in a big way, since they may not be able to buy all the physical that they want, and they'll be forced to move into the mining shares.
Here's a great quote from Bruce Pyle over at SeekingAlpha.com. The gold mining industry seems to be entering some kind of twilight zone where something fundamental is changing, but you can't seem to put your finger on it.
I think it's like a collection of things where you have 2 or 3 or 4 or 5 things that kind of all cling. They're like barnacles to the ship. The first set of barnacles that you don't even notice it, and then a few more you get on there, and it starts looking kind of ugly, and then you realize the ship isn't moving through the water as smoothly as it used to be, and finally you end up with this barnacle-encrusted wreck that it can hardly move at all in spite of all the effort of the engine to power it forward. And I think the mining industry is kind of like that. There's so many things that are coming together in a synergistic way to make it harder to get that metal out of the ground. You have grades that are going down. You have more remote locations where they're finding fewer and fewer big discoveries. You have, more and more resource nationalism where prices, are raised on the duties that that the countries charge. Sometimes they even take the project outright. You have societal issues in terms of getting these things going. And these big projects have been rolling over like ninepins, falling down. Some of them have been delayed by 5 or 10 years, and they may not even be in this cycle at all. So it's just a collection of things. And like South Africa very recently had a situation where they're talking about limiting exports of the metal, and then beyond a certain point, the producers will have to pay higher taxes for that. So it's just kind of like the death of 1,000 cuts. It's getting harder and harder to really make a good profit for these companies and for their shareholders.
You used this phrase earlier, David, peak gold, and to those of us who know what peak oil is, it's the same thing. The cheap gold is all gone, and the gold that's left is getting harder and more expensive to dig out of the ground.
That is correct. And some of these deposits are, thousands of meters above sea level. They're low grade. They need a lot of water. They need a lot of electricity. It's just really, that we talk about the perfect storm, but it's getting to be a bigger and bigger storm, and it's going to express its ways, I think, in violent tendencies for the prices of the metal itself, and then eventually for the mining shares, the ones that can survive it and flourish in that new environment.
Here's another stat I saw a while ago. I thought I'd bounce this one off you. It takes twice as long to go from discovery to production as it did only 10 years ago.
Does not surprise me at all. And you see these things, where you have a situation where a community issue can cause a stock to drop by 30% in a couple days. This happened to one of the premier silver stocks in Mexico, and it may well recover, and it's kind of recovered a little bit, but these things, that's why you have to have diversification, and no matter how good of an idea you think you have on a particular company, going all in on it is a potential recipe for disaster if everything doesn't line up perfectly, and we know in the mining business it almost never does.
Yeah, but when you look at the numbers, look at the financials here for the big five miners. They all have fabulous cash flow growth, but look at Barrick, down 25%, Anglo, down 27%, Goldcorp, down 20%, Newmont, down 24%, Goldfields, down 20%. They're all down a whack this year.
Well, they really are, and I've maintained for several years in the presentations that I've made at the different conferences that when you buy a producer, I don't care, it can be a top-of-the-line producer, very profitable, you need to expect a potential 50% drop in the share price of that producer after you've bought it. And if it's an exploration company, it may be 90%. And a lot of these will come back, but the point is that's why it's so important not to put every cent that you have in originally with the company, no matter how good of an idea you think it is or how attractive the price is, because these things really have massive volatility. And the good ones are going to really reward shareholders over time, but it can be gut-wrenching to sit through and watch your portfolio drop by 50, 60, 70%, even though you have some of the best of breed out there. So keeping a small cash reserve for what we call, or what Doug Casey calls, stupid cheap prices is a good strategy in my view.
Let's talk strategy for 2013. What should we be watching for in 2013? Any pitfalls we should be aware of? What would you do in 2013 with precious metals?
Doug Casey recently said that 2013 is going to be ugly, but it's just a warm-up for 2014. So on the one hand, I look at what the Chinese say. They have the idea that change is a two-headed sword. It can be danger and it can be opportunity. And I think we're going to have both in 2013 and 14. I think we're going to see higher prices with huge volatility. People are going to have to take some profit off the table when they get a chance and hold on to their core positions so that they lower their average price. But I think the key thing for people is going to be to hold on to what I call emotional capital. Because if you're broken psychologically, or if you run for the exits and you sell all out and it turns around and you can't get back on, I don't care if you've got $5 or $10 million in your investing account, you've been blown out of the water. You have to keep your emotions under control. And I can tell you as someone who a few years ago, when I used to get an idea, I'd put every cent I had into it. I don't do that anymore. I go in and I buy in tranches. If I have to buy right now, I get a third or a quarter at the market, or not at the market, but at limit price to get that position started. And then I am also almost rooting for lower prices so that I can buy one or two or three more tranches lower lower and save a little bit of money in case it goes way lower. And that way, I'm much calmer about the markets, even though they become more volatile. And I think that's so important for people to understand. They have to keep their emotions under control and not go overboard on any idea so that they can be around for what I feel is going to be a massive reward when we get into the last stage of this market, like what happened in 1980, where in the space of 4 to 6 months, prices went up sometimes double, triple, quadruple. And that's where the real big fruits lie. And David Morgan's going to be talking about this at the Vancouver conference in January, about what the end of a bull market will look like, where fully 80 or 90% of the potential profits that have been available for a company or a particular commodity for the entire bull run may present themselves to the astute and lucky and forceful investor right during that last time period of 10% of the move.
Makes great sense to do your due diligence, and it also makes sense to do quite a bit of reading, do some research. Is there anything that you can point us towards that would help us make wiser decisions in precious metals this year?
Well, the internet is so easy to get out there and get the information. Of course, we know it isn't all created equal, but get a list of people that you really respect and that tend to be, right more often than they're wrong, and nobody gets it right all the time, and follow those people, but then also use your own inner compass. So I don't care how good the person is, you are still responsible for your decisions, and sometimes they get it wrong, and sometimes they're too early. And so be a little bit less than you think you should, even if you're excited about something, and that way you feel you have flexibility. A good general never commits all of his reserves into the battle, except in very extreme conditions, either because to prevent a collapse in the line when the enemy forces are attacking, or because of a very unusual opportunity that he can exploit on a breakthrough. Other than that, those reserves stay back behind the line at all times so that he can deal with unforeseen consequences. And I believe that we need to be generals in the battle of investment survival and keep our reserves back there for either of those two eventualities so that we can maintain calmness when the battle is underway, and anytime we have a position, we're out on that financial battlefield.
David Smith, our guest. He is a precious metals analyst and frequent contributor to the Morgan Report at silver-investor.com. And don't forget, as David mentioned, he will be at the Vancouver Resource Investment Conference, January 20th and 21st here in Vancouver. You can get more information at cambridgehouse.com. David, it is always a pleasure. It's been a great year, and we look forward to 2013.
Well, it's been exciting and it's been frustrating, and I got to tell you, and I have a feeling that a lot of other people feel this way too. I think that the last almost 18 months have been more corrosive to hanging in there than was the case during the meltdown in 2008, 2009, because that recovered in about 6 or 8 months. I mean, my account was halved down there, and it looked awful. And then 6 months later, I was at a new high. And the last 18 months haven't been like that. They've gone to a new high, and then they've ground down, and I'm back down where I was, even though I keep a cash reserve. And it's really difficult, but I just keep looking at that far horizon, knowing that we're going to have, because it's human nature, we're going to have a massive movement at some point. I think it's going to start getting underway. It won't be the last leg, but it'll be the next leg, into next year. It's going to be all over the board, and that'll be setting up for a bigger move probably in 2014, and this could go up for several more years, but we've got at least 2 more years, I think, to get to that point of a blow-off, and it could be as much as 4 or 5, but in any event, I want to be there at the table near the end so that I can claim my just rewards.
We want to hear all the action, and we look forward to hearing you tell us more about it as we go along during the year. Thanks, David.
Okay, great, Phil. Nice talking to you, and have a great new year.
Thanks to our guests, Ross Clark and David Smith. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next year with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.